What is up, everybody? I'm James, and you're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Saturday, everybody. We have another great episode here for you. This is, without a doubt, one of those episodes you should share with people, and it's in particular people who manage their own investments, because that's what I want to talk about today. Everybody can manage their own investments. Very crazy to say that, especially as someone who manages other people's investments. But throughout my decade-long experience doing this, the one thing I've noticed is that anybody can do this, right? Even if you just put it in the S&P 500, you're going to do good, all right? And again, I'm not allowed to give investment advice. I'm even supposed to say that the S&P 500 is exposure to equities and it's extremely risky. Well, let me tell you something. Any investment that you make that has a quote unquote guarantee from one company, AKA an annuity or insurance, in my opinion, okay, not financial advice, my opinion, that is less safe than the S&P 500. And there's a reason for that. Guess what it is? It's 500 companies versus one. Okay, there are insurance companies that sell these products that are in the S&P 500, and most of them aren't even in it. So the idea that 500 of the world's largest companies, the U.S. largest in the U.S. However, the U.S. alone, those 500 companies, they make up 45% of the world's economy, okay, of consumption, of production. That is safer by just a 6-year-old. You could give a 6-year-old 500 blocks and versus one block, and the 6-year-old will understand that having 500 blocks is stronger, or it builds a better building than one block does. Okay, that is the concept that I want you to think of with the S&P 500. A lot of you don't need that information. You already understand about the market and whatnot. But I encourage you, especially those who do your own investments, to compare your growth portfolios, your growth investment policy statement, like what you're trying to do, your strategy, compare that to the S&P 500, because that is like the momentum. That's the speed of the river that you're going down. Now, if you can build a boat with a motor and you can go much faster down the river, that's great. That's what we're trying to do. That's the alpha of a portfolio. That's why someone like me might provide value, right? But like I said, this isn't about, about what I do for people today. This is about how I think you can do it yourself and how you don't need someone like me. You want someone like me. Okay, so with that said, our quote of the day comes from the late and great Charlie Munger. And for those of you who don't know, Charlie Munger started working with Warren, and Warren had a habit at that time. Warren Buffett, by the way, just in case we have any beginners in here. Warren started, he really loved value companies. If they were cheap, he wanted them. If he thought they were at a discount, he wanted to buy them. And Charlie came into the business, into partnership with Warren, and gave him a much, what's the word? Articulate, maybe, not fancy. Articulate's pretty good, but just a more pristine point of view. So let me read this quote for you. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. I'm going to read that again. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price, right? And Warren had already had some success doing the latter, right? Buying a fair company at a wonderful price. But Charlie came in and just tweaked Warren's perspective a little bit, and it made all the difference. It made billions upon billions upon billions of dollars of difference. So, and I want to try to tweak your guys' perspective here too, because a lot of our listeners, you might be individual traders, you might have a financial planner, you might have no money at all, and you're just like, I love this stuff. How do I get involved? I encourage you, please spend the time. It is yes, there are complicated terms, but overall, it is very easy to learn about your options with your money. Okay, very, very easy. Now, it is intense in the sense that I think there's a lot of material. It's kind of like the Great Lakes, right? Like the Great Lakes are massive. You can't see the other side of them, but they're pretty shallow, right? You don't need to have this depth of knowledge. If you just stay on the surface level and enjoy your time around the lake, I promise you, you will become a great investor. I promise. So, other than that, what was the main focus on being your own investor here? Oh, yeah, big thing. The idea of investing, there's really only three things. Okay, only three things. And I'm keeping it on the Great Lakes surface here for everybody. And even if you're a pro here, you're a seasoned pro, this will be useful because it sets the frame. And framing and investing is the most important thing. Okay, in our heads, and there is an argument for this. In fact, I tend to believe this simplified perspective, but in our heads, the most important thing is, did we make money? What's the rate of return? I would argue that 100% is the most important factor. That's just my opinion. Now, when you're old and retired and you're living off your investments, that's a different conversation. Now it's about maximizing what you've done. But most of you here probably aren't in a perspective where you're living off your investments. You probably got a job, you probably trade on the side, or maybe for your full-time career, or maybe you just have a 401k and you're like, man, is this all there is? Like, how do I grow this bad boy? You need to zoom out a little bit. Okay, zoom out a bit in the sense that rate of return is very important. And when you work with professionals, sadly, just like me, a lot of them don't say that. Okay, they want to make money off of the work you've already done. And it's part of the reason why I'm so sick of the industry and I can't stand them. And pretty much every time I talk to somebody who's in the industry, I can tell right away, within 5 minutes, about their investment philosophy, if they even understand investments or not, right? A lot of them just know products and they know how to sell stuff, and they work for a BD or a wirehouse and they're annuity sharks or insurance sharks. It's just gross. So think rate of return. Realistically, that probably is the number one most important thing when you're trying to grow your wealth, okay? But there is a big... How do I phrase this? There's three factors. I'll just jump into it here. It's risk, reward, and volatility. Okay, all of those words, they're buzzwords. You've heard them before. You kind of know what they mean. You kind of don't. This is what I want you to know. In this game of investing, and it's not a game, right? It's not, but in this world then, those three things, they're never known beforehand. Okay, risk, reward, volatility. You cannot know what's going to happen. And that is one of the most difficult things about this, about even my job, but about the industry, is that you really are taking, you are making an assumption when you invest in something, right? And what my job is I gather as much evidence as I possibly can. We'll use Palantir as an example. Palantir didn't do well for like 3 years. I think they went public in 2021. Don't quote me on that, but I'm just using them as an example because that was one of our firm's best picks, right? These last 2 years, it's killed it, 700%, whatever it is. It's absolutely killed it. No one knew what was going to happen. It was all an idea. But what I noticed about that company is there was evidence that it was going to be an absolute 10-bagger. And now, my perspective on it through these now 3 years that we've been in on it, it is without a doubt one of the best companies in the world. It just had one of the best earnings reports ever. I love it. Okay. But it was a risk. Okay. It was a gamble in the sense of not gambling, but there was a chance that it was not going to be as great of a company as it is. All right. And that is the nature of this beast, is you have to just be as prepared as you can for how that beast reacts. Okay, and you know, obviously there's a little bit of luck in here, but in most senses, you can get a very high perspective on a company by just doing a little bit of research. Okay, Peter Lynch, his investment style is exactly how I like to invest in companies that I've never heard of. Palantir was one of those companies. His style is, La Quinta. That was one of his best picks in his Magellan fund in the 80s. He likes to go he stayed at a La Quinta, right? That's a hotel for those of you who don't know. He would go stay there. He would talk to the employees. He would get an idea from management there. He wanted to get a perspective intimately as a consumer about what this company produces. And he fell in love with it. He put millions of dollars into this company. What ended up happening? That ended up being a 10-bagger multiple times over. Great company for him. I want you guys to think about your investing the exact same way. All right, with Palantir, I didn't understand software. I didn't know what they were doing. I couldn't go buy their product or buy their service and then try to implement it. I had to do a lot of research. Okay, you need to get intimate and dig down with the companies that you want to invest in. Otherwise, there is nothing wrong with just setting your money in the S&P 500 and waiting. Okay, think of it again. It's the 500 largest companies. What could be, if that Jenga set fell apart, right? 40% of a Jenga game, the whole thing's going to fall. What ends up happening is there are corrections in price in recessionary periods, even a depressionary period. These companies, nothing about them probably has fundamentally changed. You're probably going to be able to get things at an extreme discount. So if I was a millennial, which I am, I wouldn't be too upset if I was investing my own money and there was a correction, okay? Because I know I'm going to get things at a great price. If I could get Palantir at $10 again, I would love that. All right, and you should too. And that is how these corrections work. Okay, back to risk, reward, and volatility. What I want you to think about, even if you're a seasoned pro in this, you cannot know them. And because you cannot know them, it's the beast you don't know, you need to be as prepared as possible for all scenarios. And people who don't want to do that, you better trust your advisor, because investing is one of the number one ways you're going to build wealth. It just is. Either that, build a company, get an inheritance, or win the lottery. Those are really the only ways that you can build real wealth. And what is real wealth? It's wealth you're excited to leave your kids. You know, when you have to have a talk with your kids about how much money they're going to inherit, that's wealth. All right, and there typically is a dollar figure right around 10 million. That's going to change with inflation and income expectations and Social Security. There's a whole bunch of other factors there. But risk, reward, and volatility cannot be known. And the last one, volatility, this is the most important one for you. People who invest their own money, you are emotionally attached to it. And you will make bad financial decisions because you can't stomach a drop. All right? There is no reward without risk. Okay, and there is no risk without volatility. So you have to get comfortable with these big swings. And my encouragement to you is view it as an opportunity to buy things at discount. So the first thing is believe in the companies. Understand them intimately. I can explain Palantir explain it to a fifth grader would probably be pretty tough. But I can explain it to somebody who plays Halo, because that's the way I viewed it. And I was trying to talk to an eighth grader the other day about it. Why was I talking to an eighth grader? It was a family friend, and he was asking me about my job. So don't make nothing weird's going on. But we were talking about, like, whoa, Palantir, like you mentioned that in your podcast on other episodes. Like, what is it that, like, why do you like that so much? Palantir is creating Cortana. Okay, they're creating Cortana that from the Halo games. Pretty much everybody who listens to us has heard of Halo. And if you haven't, you're living under a rock and you're missing out on one of the best video games of all time. But they're creating Cortana, which is the AI that helps him basically become extremely successful in all of his missions. It's predictive information and kind of what are the odds of things happening and how efficient can you be. That is what Palantir is creating. So that's the level of depth you need to be able to understand. You need to be able to give a description of these companies you're investing in to an eighth grader, to a fifth grader. You have to be able to do that. One, that's going to teach you, right? If you can have confidence in the way you're describing something, I mean, boy, that's going to, when markets do drop, that's going to give you confidence. I'll give you an example. Palantir was at 185, 188 right after their earnings. It was at 148 2 weeks ago. Well, what did I do? I went with every single one of my clients who already has Palantir, right? A lot of them have made a lot of money. And I go, hey, we're at 188. Maybe we should consider taking some profits. Like, don't be, we're not so greedy that we wait. Okay, it's like what I'm trying to say is when you win $500 at the casino and instead of leaving, you're like, okay, well, now I can turn this into $3,000. You don't have to do that, right? I would tell you, people react to volatility very harshly. So when you do have those big swings in the positive direction, take your profits. And we'll talk about this more on Monday. I'm going to dive into when you take profits and whatnot, but you need to not, like, it's okay to take your winnings and play with house money is what I'm saying. And so volatility goes both ways. You got to be ready for it, right? So risk can't be known, reward cannot be known, and volatility can't be known. But there is no reward without risk, and risk only exists because of volatility. So my encouragement to you guys is do not invest without intimately knowing what you're doing and having a strategy, right? Being prepared for that volatility. Volatility for me, for my clients who are especially in the growth portfolios, it's exciting because I know we own great companies, and when those companies drop, that's a discount. All right, we're going to Costco and we're getting 15, I don't know, what's peanut butter. That's the only thing that came to my mind, but we're getting 15 jars of peanut butter. Now, I know I don't need 15 jars of peanut butter right now, but if they're 50% off, it's like, oh, let me get as much as that as I can, right?